Welcome to the Deep Dive. Today, we're taking a closer look at Careium AB. That's ticker Careium B. They're the big European name in tech-enabled Telecare, alarms and monitoring for seniors.
That's right.
We've just gone through their Q2 fiscal 25 results, the market reaction, all of it. And we're here to basically cut through the noise for you.
Get straight to what matters.
Exactly. Because the big question after these numbers came out is, was this Q2 just a temporary blip, or is something deeper shifting for Careium?
That's the core question, absolutely. And the immediate market take on Careium's Q2, well, let's be honest, it was clear disappointment.
Yeah, you could feel that.
The headline numbers, revenue, earnings per share, they both came in softer than expected, lower than what the street was looking for. The focus just went straight to that top line miss.
Okay, so the first impression was pretty negative, but if we look under the hood a bit, want it all? Anything else stand out?
Oh, definitely not all bad. What's quite interesting here is, despite those top line issues, they actually managed a pretty healthy bump in gross margins.
The profit on their core services.
Exactly, before operating costs. That improved by 160 basis points, hitting 43.3%. That really does point to some efficiency work paying off underneath, a definite silver lining. But yeah, like always, the headline numbers are just part of the picture. There's more going on here.
All right, let's unpack that revenue miss then.
Yeah.
Because it wasn't just one single factor, right? They reported an 11.9% year-over-year drop. Yep. What were the main culprits?
Yeah, there were basically three main things driving that decline. First, a pretty significant accounting headwind in Sweden.
Okay.
It's about how they classify financial leases. A change in recognizing revenue from certain contracts. It's temporary, but it knocked off SEK 15.1 million in comparable terms this quarter. 15
million.
Okay.
It's not insignificant. And it's not just a Q2 thing, is it? Management said it'll hit Q3 and Q4 comparables too.
That's right. SEK 24.2 million impact expected for Q3 comps. SEK 15.2 million for Q4. But they do expect it to, fade away starting in the first half of 2026.
So it's a bit of short-term accounting noise, but the idea is it leads to more stable recurring revenue down the line.
Yeah.
As more contracts get classed as operational leases.
Precisely. It smooths things out eventually, but hurts the year-over-year comparison right now. The second big factor was lower product sales.
Right.
That was an SEK 11.9 million decline. But it wasn't necessarily weak current demand. It was more about facing incredibly strong numbers from Germany and Norway in the same quarter last year.
Ah, the tough comparison problem, trying to beat your personal best every single time.
Exactly. Sometimes the previous year was just exceptional. And then finally, there was also a negative currency effect, about SEK 5.9 million.
Okay, so like a triple whammy hitting that top line. Accounting, tough comps, and currency.
Yep, that sums it up.
You mentioned the gross margin improvement earlier, which sounds good.
Mm-hmm.
But how did that flow through to the operating profit, the EBIT, with revenue down?
Well, that's where you see the impact. Even with better gross margins, the operating margin, EBIT, still basically halved, dropped to 4.9%.
Ouch.
Yeah. It was mainly the lower net sales overall, plus, and this is important, they're actually increasing spending on sales and development initiatives. The better gross margin helped cushion the blow a bit, but couldn't fully offset it.
And cash flow.
Operating cash flow took a hit too, down to SEK 20 million from 40 million last year. Free cash flow, though, was flat at SEK 1 million.
Okay. But the balance sheet itself still looks reasonably strong. Cash on hand, debt levels.
Yeah, the balance sheet seems solid. SEK 34 million in cash, net debt at SEK 178 million. That puts leverage at about 1.3 times. Plus, they mentioned having access to credit lines, for potential M&A activity.
Got it. And I noticed capital expenditure, CapEx, was up. What's behind that increase?
That's actually tied into that strategic shift we mentioned. CapEx is higher because they're doing more operational leases. So they're investing more in the actual physical equipment they lease out. It increases the tangible investments, but it supports that move towards more predictable, recurring revenue streams. Spending now for future income.
Right. Investing in the model.
Yeah.
Okay, connecting this all together, what's management saying about the rest of the year? The CEO, Christian Wellan, he stuck to the full year targets.
He did maintain the full year guidance. The message was basically expect a softer first half, which we've clearly seen, but a stronger second half. They're guiding for improvements in net sales, profitability, and free cash flow compared to 2024 levels in H2.
Okay, so they're optimistic about H2. What's supposed to drive that turnaround? What are the key catalysts?
They pointed to a few specific things. First, a big new contract kicking off in Norway in Q4. Sounds like around October.
Okay, significant new business.
Second, another major win in the UK in Gloucestershire. That's a fully managed contract expected to start in Q3.
And those fully managed contracts, they're a big deal in this sector, right?
Right.
More comprehensive.
Huge deal. It means Careium handles everything, installation, monitoring, the whole service package. They're not just providing hardware. It's great for revenue stability, but also acts as a really important reference case. Shows they can deliver the full solution.
That makes sense. A showcase win. And you mentioned France earlier, too. What was the news there?
Yeah, France is strategically very interesting. They landed their first substantial order for stationary alarms, the hubs in France.
And why is that significant?
Because France is aggressively shutting down its old 2G and 3G networks, the PSTN network 2, through 2030. This creates a big need for updated digital solutions. And Careium, while strong in mobile stuff there, hadn't really cracked the market for these core stationary alarms before. So it's a key breakthrough into a potentially large replacement market.
Got it. Opening up a new necessary product line in a market undergoing a tech transition. Smart.
Exactly. And alongside these contracts, they're also doing work internally, overhauling their web and digital infrastructure, trying to boost their direct-to-consumer B2C efforts, moving off older systems.
Modernizing the back end, too. And what about M&A? They mentioned more activity.
Yeah, management noted the M&A landscape in their sector is heating up. More conversations, more dialogues happening than before.
Suggests maybe some consolidation is coming.
Yeah.
And Careium could be involved?
Potentially. With their balance sheet, they seem positioned to be a potential buyer, not just watching from the sidelines. And linking back to strategy, they're also pouring money into R&D.
Right, building out that platform.
Building out their end-to-end platform, looking at AI for their call centers, developing new monitoring tools. Plus, they're migrating their Swedish users onto their own platforms, which they started last May, and they say it's already showing efficiency gains. It's all about creating that integrated tech ecosystem.
Okay, so that's the company view. Let's talk about the markets they operate in. What's happening on the ground in, say, Sweden and the UK? How are those external factors playing in?
Well, in Sweden, there's a bit of uncertainty. The government's plan to modernize Telecare for individuals, the ATA framework, got pushed back to May 2026.
Okay, a delay in the big framework rollout. What does that mean practically?
It could mean fewer new tenders coming out in the short term. They actually said the market for available contracts in Sweden is down maybe 20% to 30% from normal right now. Slower market.
But the flip side is municipalities might have to extend existing contracts, maybe even pay a bit more. So the net effect is, well, still a bit unclear. Creates some headwinds for now, though.
And over in the UK, service revenue was down there. Any specific reasons?
Part of that was expected. They had a planned departure of a big contract with the Council of Oxford.
Ah, okay. So that was known.
Yeah. But there's also just natural fluctuations sometimes in private pay users and non-recurring stuff like mobile response call-outs or assessments. It adds variability.
Which just reinforces why those big, stable, fully managed contracts like the Gloucestershire one are so important for the UK business.
Exactly. They anchor the revenue base.
And there was also a shift in their assisted living strategy. What happened there? Right. They didn't qualify for a Swedish assisted living contract, the ADA one, apparently due to their focus on remote monitoring solutions.
Interesting. So what's the pivot?
They're redirecting those efforts towards the UK market, specifically targeting what they call schemes, basically, communal living facilities. Lots of older analog equipment there that needs upgrading. It's a big potential market. And they're also putting more focus on Denmark.
Okay, shifting focus to where the opportunity looks better. It sounds like management feels they have good control over some things, like gross margins through efficiencies.
Yes, they highlighted that. Supply chain, internal processes.
But less control, or at least predictability, over other things, like product sales.
Yeah, they admitted forecasting product sales is tough. Especially in the UK, you can get these large, unpredictable call-off orders that make volumes lumpy. It's hard to predict the timing.
The million-dollar question is, can they smooth that out over time?
That's the challenge. On operating expenses, they're looking for savings across the board, but, and this is key, they are deliberately protecting, even potentially increasing, investment in R&D and their commercial teams.
Because that's the future growth engine.
Exactly. They see that tech platform and the sales capability as critical. They're willing to spend there, even when trimming elsewhere. It's about investing in that software-led future, not just being a hardware seller.
All right, let's shift gears a bit. Time for the segment where we explore some thinking that goes beyond the headlines, maybe into the more strategic long-term game. And just to be crystal clear, this is purely for discussion, definitely not financial advice.
Absolutely. For discussion purposes only.
Okay, so the setup. Careium stock takes a hit. Why? An earnings miss, yes, but driven largely by that temporary Swedish accounting thing and tough comms from last year. The market heard management's H2 optimism, seemed to find it credible, but, well, not quite enough to overlook the Q2 miss.
Right. The market reaction was pretty immediate and negative.
So here's a thought, maybe slightly outrageous, but perhaps plausible. The idea isn't just a straight bet that Careium suddenly re-rates massively this quarter. It's more nuanced. It's a bet on Careium diverging from its peers.
Okay. Diverging how?
Well, the market kind of lumped Careium in with other Telecare names after the results. But maybe it's specific strategic moves that break through in France, the big fully managed UK wins, and crucially, that heavy protected R&D spend on building a software ecosystem. Maybe that signals a fundamentally different, more capital-efficient, higher-margin future model compared to more traditional players.
Interesting. So you're saying the market might be missing a transformation that's underway?
Potentially. And here's the twist to make it a more concrete idea. Maybe the trade isn't just long Careium on its own. Maybe it's a pair trade.
Long Careium, short a competitor.
Exactly. Long Careium and short a more traditional, perhaps less tech-focused Telecare peer. The initial bad reaction dragged down Careium, and probably some similar companies too.
Right. Sector sentiment hit.
So if Careium actually delivers on those H2 contracts, and maybe even more importantly, makes real progress on that R&D roadmap towards being a platform provider, not just a box shifter.
Then you're betting its business quality improves in a way its peers might not match.
Precisely. It hedges you against general weakness in the sector, but lets you bet specifically on Careium's transformation, which might be underappreciated right now. It's basically a bet that the market is mispricing a software transition happening inside what looks like a hardware company.
A bet on the strategic execution and the market eventually recognizing that shift. It's definitely food for thought.
So wrapping things up, Careium delivered, let's face it, a challenging Q2 on the surface numbers.
Yep, the headlines weren't pretty.
But they showed some underlying strength in gross margins, and they've laid out some pretty clear reasons, new contracts, strategic wins for why the second half should be stronger.
The H2 story seems plausible based on those specific drivers like Norway and the UK contracts.
So for you, the listener, the key things to watch are, can they execute on that H2 guidance? Do those big contracts in Norway and the UK ramp up smoothly? And what progress do we see on that digital platform and maybe even on the M&A front?
Execution is everything now.
Which leads to the final thought. If the market keeps focusing on the temporary accounting noise and those tough prior year comparisons, are they missing the bigger picture? Are they potentially overlooking a deeper strategic shift here?
A shift towards potentially a much higher margin, platform-driven business model that could really change their long-term trajectory in this whole European aging care market.
That's the question to ponder. Thanks for tuning in to The Deep Dive.